and I'm here to address what I call the reward to risk ratio myth. There's a commonly held view that unless a trade can provide a reward to risk ratio of 3 to 1 or at least 2 to 1, then it's not worth taking. And so I want to dispel that myth and show you why that's the case. Okay, here I've got a little chart that I drew up. This is the reward to risk ratio based on the initial stop that you would place for the trade and based on the initial profit targets where you would exit the trade. So the two together you'd be able to calculate the reward to risk ratio. Well, here's a 3 to 1 ratio, a 2 to 1, and a 1 to 1. I'm going to show you why a 3 to 1 ratio or 2 to 1 ratio isn't necessarily what you want as a trader, as a swing trader. Now, what's not commonly understood is the typical winning percentage for each of these scenarios. So if you have a 3 to 1 reward to risk ratio and you're trading a good method, all of these examples assume you have good methods. If you don't, well then all bets are off. It doesn't matter what the reward to risk ratio is. Okay, so assuming we've got a good method that delivers 3 to 1, such a method typically delivers 1/3 of the trades profitable. It's very common. So let's see what the actual reward to risk ratio is. If you had a winning trade of $300 and 2 losing trades of $100, you'd have a net profit of $100 after 3 trades. So the reward after 3 trades is $300. The risk is $200, the 2 losing trades. So the reward to risk ratio is 1.5, not 3. This is the ratio that really counts. Now, let's look at the 2 to 1 scenario. Typically, 50% of the trades will be winners. So, if a winning trade is $200 and a losing trade is $100, 2 to 1, you can have a $100 profit after 2 trades. The reward to risk ratio, 200 profit, 100 loss, is 2 to 1. So in this case, the initial is 2 to 1 and the actual or expected is 2 to 1. So you can see, just based on the expected reward to risk ratio, you really might want to trade the 2 to 1 method versus the 3 to 1. Especially if your risk tolerance is low, who wants to lose 2/3 of the trades? Indeed, who wants to lose half of them? All right, let's look at the 1 to 1. A good method with a 1 to 1 ratio typically will deliver 2/3 profitable trades, winning trades. You know, why is that? Because, first of all, you're not placing the stop so tight as in a 3 to 1 method. So you're not going to get stopped out nearly as often. That'll boost the percentage of winning trades. And your profit target is not as aggressive, so you're much more likely to reach it than you are in this scenario. I mean, that's what's going on behind the scenes. All right, so let's run the play here. You had a profitable trade of $100, another one of $100, and a losing trade of $100. That's 2/3 of your trades are winners. Net profit, $100. What's the reward to risk ratio? Well, for those 3 trades, you made $200. You had to lose $100 to do it. It's 2 to 1. This one was 2 to 1. This one, 1.5 to 1. Now just look at those 3 scenarios. What would you rather trade? A method that wins 2 out of 3 times? Or be insistent on, I have to have a 3 to 1 reward to risk ratio or it's not a good method? and only win 1 out of 3 trades, I think you'd pick this one. Now, it gets even better if you apply our free trade strategy. Starting off with a 1-to-1 ratio with the free trade strategy makes it even better because we want to zero out all of the risk in the trade as soon as possible. And when you do that, theoretically have nothing but profit over zero risk. That's an infinite reward to risk ratio for that trade. So to summarize, the initial reward to risk ratio of 3-to-1 actually comes in at 1.5-to-1. The 2-to-1 actually comes in around 2-to-1 as well. And the 1-to-1 also comes in at 2-to-1, or even better with the free trade strategy. And we designed Forex profit multiplier methods around this scenario. Why? Because you will have the probability of getting overall better results, number one. Number two, you're going to have a higher percentage of winning trades, and that's very important from a psychological standpoint of maintaining your confidence and your ability to pull the trigger. Now, I'm going to show you a chart that demonstrates all of this. Okay, here's US dollar Japanese yen 4-hour candlestick chart. And with the Forex profit multiplier, you'd have got to set up an alert on this bar right here to go short right around in here for a nice quick trade down, hitting both profit targets, the initial stop right in this area here. And as soon as the first profit target is hit, we move the stop down to break even. And that zeroes out all the risk in the trade. We call that the free trade. Okay, now, that's generally, if you looked at the pips, initial stop, the profit target here, that's about a 1-to-1 initial reward to risk ratio. By zeroing out all the risk in the trade, it becomes a 1 reward to 0 risk, which is an infinite reward to risk ratio. You see? So it's not just the initial stop and profit targets, it's how you manage the trade. It's very important. Now, supposing you were insisting on a 3-to-1 ratio here, that means the profit target would be, let's see, down here somewhere, which in this case would have been hit because the market did go to that level. But what if it didn't? What if it bottomed out here and went up? Well, with the 3-to-1 method, you'd have a losing trade because you're insisting on a 3-to-1 ratio. With the 1-to-1 method, or like Forex profit multiplier methods, you'd be safely out with a winning trade. Now, you might say, well, yeah, but look, you missed all of this. Well, no, you didn't, because the Forex profit multiplier came right on back and gave you an alert right here to get short. Another great trade. Initial stop, first profit target, second profit target. Another 1-to-1 going in, reward to risk ratio, but move the stop to break even as soon as the first profit target's hit. Changing that to 1 over no risk, or an infinite reward to risk ratio. And you're still capturing most of this move down. Well, what about this? Another alert sets up right here. Forex profit multiplier gets short right in there. First profit target's already been hit. Now the market, as we speak here, is rallying, but now the stop's been moved down to break even on the second half position. So now it's a matter of waiting. What'll happen? Either be stopped out at break even or hit the second profit target. Now, this is a profitable trade. This is a profitable trade. This is already a profitable trade, even if the second half gets stopped out. So you see what I mean? With the 1-to-1 ratio going in, your percentage of winners is going to be significantly higher than it otherwise would be. Okay, to wrap up, I just want you to know that everything we just talked about is included in the Forex Profit Multiplier program, and I look forward to working with you as one of our new students. This is Bill Polis, wishing everybody good trading.